Hello everyone, I am Dr. A.G. Maitli, Assistant Professor, Department of Commerce with Finance, Dr. SNS College of Arts and Science. This video is about financial statement fraud in forensic accounting. So what is a financial statement fraud? So the financial statement fraud, it is, you can say it is a fraud that has occurred in financial statements such as profit and loss account, balance sheet, or any cash book, or anything related to financial statement. So you can say it is a manipulation, misrepresentation, or alteration in financial statements. It can be by an individual or an organization. So this is done to show their performance and financially healthy. This type of fraud involves representing false or misleading information in financial statement. So it includes a balance sheet, income statement, cash flow statement, fund flow statement, etc. So the financial statement fraud it is intentionally it is manipulated or misrepresented or altered financial statement. So this is you can say it is a white collar crime that have severe consequences for investors, creditors, employees, and then other stakeholders, bankers, etc. It is often committed by individuals or an organization who have access to those financial informations, and they have the ability to manipulate those informations or records. So this financial statement records, it may include, that is, motivation behind all these things to incur a financial fraud is financial gain. So inflate revenues to access or increase the company's apparent profitability, or concealing poor performance when the company is going on a poor performance to show it is going in a healthy way. So they'll manipulate and show that higher profits have they earned and the losses to maintain investors confident and to avoid decline in their stock prices. Scrutinizing financing, that is healthier financial position for attracting loans from banks and investment from the investors, and then avoiding regulatory scrutiny, concealing financial regularities to avoid investigation or sanctioning. So maintaining executive positions. So to maintain executive positions, they have to show for performance, positive performance. So they can't show the negative performance for their publicity. So all these factors, it motivates for the financial statement fraud. So some of the common techniques used in financial statement fraud. So here financial statement fraud will not take place without combining of these three ingredients, that is an executive who will be benefited, subordinate or the accountant, others willing to assist, and then gatekeepers, that is the auditors or board of directors. Without the three people, the financial statement fraud will not happen. So we can say these three are the key ingredients for financial statement fraud. So common techniques used in financial statement fraud are revenue recognition manipulation, that is showing more revenue than what has been happened in the business. So expense manipulation, that is capitalizing expenses to artificially to boost assets and improve financial ratios. So asset valuation manipulation, overstating the value of assets, that is more than the value of the asset or the inventory or property, to inflate the company's net worth, and then falsifying the valuation of investment to show higher returns, and then reserves and allowances manipulation to smooth out earnings or to create cookies jar reserve for future periods. So next one is regulate party transaction, engaging parties to manipulate financial results And then off balance sheet transactions, using off balance sheet entries to conceal debt or liabilities, hiding contingent liabilities to prevent a more favorable financial position, and then earning management, employees aggressively accounting practices to meet or exceed earning targets, and then implementing big bath accounting to take significant write-off in a single period, or channel shuffling, inducing customers to purchase more goods or services that needed to inflate sales figure. So these are all some of the common techniques used in financial statement fraud. So how to detect and prevent these fraud? So detecting financial statement fraud can be challenging for each and every organization, but preventive measures and vigilant oversight can help to mitigate the risk. So the key strategies include are, so here, detection of fraudulent financial statement schemes, SAS 99, the consideration of fraud in financial statement audit. The auditor has the responsibility to plan and perform the audit to obtain reasonable assurance about whether the financial statements are free from any material misstatements or misappropriation, whether caused by error or fraud. So the statement is error free. So the key strategies followed can be internal control. So there should be strict internal control. So we have to find out the loopholes, and you have to strengthen those loopholes in the organization. Next one is segregation of duties. So the duties to be segregated to responsibilities and duties to be segregated to different persons. Some persons should not be handling the cash. Each and every time they have to shuffle the persons. Whistleblower programs. So encourage the employees to whistleblower. If any of the employees making any fraud, they have to whistleblower to the higher authorities. So independent audits. So conducting independent audits periodically can also help to detect fraud. So ethical corporate culture, following ethical corporate culture within the organization also helps to detect fraud. And then education and training. So educate employees, especially those involved in financial reporting, about the importance of ethical behavior and consequences of financial fraud. Data analytics. Use data analytics tools to detect unusual pattern of anonymous in financial data that may indicate fraudulent activities. Next one is revenue recognition detection. So detecting revenue recognition fraud is a crucial aspect of financial statement analysis for forensic accountant. So revenue recognition is manipulating involving timing, amount or nature of revenue. So this can be done through comparative analysis, that is year to year comparison. So comparing this year with the previous year. So sales, returns and allowances analysis, trend in returns, analyzing trend in sales, return and allowances over time, sales cutoff, etc. And then ratio analysis, by comparing the ratio analysis, this can be done. And then cash flow analysis, cash inflows and cash outflows can be analyzed to detect the fraud. Deferred revenue analysis can be done in financial statement. Contract and sales allowances review. And then customers and sales channel analysis, this can be also done. Consistent with industry standards. And then unusual payment pattern, customers unusual payment pattern, that is analyze the customer's payment to identify unusual or irregularities payment. And then sales cutoff testing can be done. End of period sales, review sales transactions occurring at the end of reporting periods, verify those transactions and the timing of revenue recognition. And then sales incentives and discounts, that is review sales incentives, evaluate sales incentives and discounts offered to customers, assess those where incentives may lead to permanent revenue recognition. And then revenue recognition policy scrutiny, thus consistency with the industry standard, review the company's revenue recognition policies and ensure that they are aligned with the industry's standards and accounting principles, and then customers payment pattern. Deviations from standard pattern indicate revenue recognition, and then red flag indicators, and then behavioral red flags, whistleblower tips and compliance, data analytics, then in external confirmations, that in legal and regulatory compliances, management representation, that is interview management. So these are all the some of the techniques that can be used for revenue recognition detection. Next one is, here are some of the high profile examples, that is the companies which are incurred a financial statement fraud. That is Enron in USA. The type of fraud is here off balance sheet debt hiding. They hide the debt, and it is impact on bankruptcy. And then WorldCom, again it is an USA company. It capitalized expenses as assets, and that fraud impact is about $11 billion. And then Satyam Computers in India, falsified cash balances and revenue. So this impact is about $1.5 billion fraud. So there are laws and regulatories in India and globally to prevent all those frauds. So in India, it is about the Companies Act, SEBI's regulations, and ICAI accounting standards. So these are all the boards for the laws and regulations for the accountants to be followed in India. In US, Sarbanes-Oxley Act, SOX, SEX regulations, etc. In global, it is IFRS, PCAOB guidelines for auditors. So when you follow all these laws and regulations, so the frauds can be can be detected, and it can be minimized or it can be avoided by the corporates. So thank you.